Hey guys, this is June Collier, and in this training, I'm going to discuss the 7 stock category classifications. Now, stocks are going to fall into one or multiple classifications. Investors love putting stocks into various categories in order to make it easier to identify the stocks. There are probably over a dozen stock classifications, but I'm going to describe the 7 most common. Now, the goal of this course is to teach you what the 7 stock category classifications are. Upon completing the course, you will understand stock classifications. Now, stocks are among the most common forms of investment, and most people understand the basics of owning a stock. But there are different categories of a stock, and each has its own advantage and disadvantage. These differences make some stocks better investments than others, depending on the situation and in some cases, depending on the economy. Some stocks can fit into multiple categories, and many of the categories have overlapping features. So let's jump straight in. Blue chip. Blue chip stocks tend to be what is known as the cream of the crop in the business world. These companies lead in their respective industries, and they have strong reputations. They typically don't provide the absolute highest returns, but their stability makes them a favorite among investors with a low tolerance for risk. Blue chip companies often make regular and growing dividend payments, and with solid business models, blue chip stocks have produced long records of attractive returns, and that's made them among the most popular individual stocks in the stock market for conservative investors looking for a place to put their money to work. I like to take new investors and put them in blue chip stocks, again, because of their stability. Let's take a look at the second. The second is speculative stocks. Speculative stocks are issued by startup companies. These are going to be IPOs. These are going to be companies that are developing new products or technologies, maybe even companies that are exploring untapped foreign markets, or companies that have undergone drastic management changes or financial restructuring. These stocks carry a high amount of risk because the companies are often untested and many do not succeed. But the payoff can be substantial if the company succeeds or if enough investors buy into the company and raise the value of the stock. Now, growth stocks are issued by companies that are consistently reinvesting profits back into the business to fund development. Growth stocks do not pay high dividends or dividends at all. Instead, as the company grows and its value increases, investors receive higher capital gains on the increased value of the stock. Now, these stocks can lose value when growth slows as a natural effect of the business life cycle, or if the company experiences a financial downturn that decreases the profit it can reinvest into the company. But growth stocks are good companies that are reinvesting their profits back into the company. Now, value companies. Investors believe that value stocks are underestimated by the market. This may be because of the industry that the stock is in is experiencing some type of trouble, or because the company is new and unproven, or because the company doesn't fit all the criteria for stronger investments, such as an income or growth stock. But this stock has the potential to do so. So investors who purchase value stocks believe that they're getting a bargain on shares that will become more expensive in the future when the financial tide changes or the company grows. This is an area where Warren Buffett loves to purchase stocks. He loves value stocks. Number 5 is income stocks, also known as dividend paying stocks. Income stocks are the least volatile classification of stocks, and they offer investors steady dividends. Most income stocks are from large companies with limited room for growth, so much of the profit is paid back out to the shareholders instead of being reinvested into the company, as we saw in growth stocks. Now, this leads to a larger dividend than most stocks can offer and a fairly reliable income for investors. Income stocks are usually found in traditionally stable sectors such as natural resources, food, energy, utilities, financial institutions, and real estate investment trusts. Many income stocks are considered blue chip, which means that they are issued by well-established companies with a long history of positive finances and steady dividend payments. We're going to be talking about dividend stocks in week number 5, and we're going to be looking at income stocks. Number 6, cyclical. Cyclical stocks increase in value when the economy is strong, and they lose value during economic decline. These stocks often represent companies that offer luxury and discretionary goods and services. This can include airlines, manufacturing, companies that manufacture and sell electronics, jewelry companies, those types of things. Cyclical stocks can lose a substantial amount of value during tough economic times, but they're able to regain and even surpass their former value once the economy recovers. Louis Vuitton would also be a cyclical stock in this category. Last but not least, defensive stocks. Now, defensive stocks are sound investments during economic downturn because industries and companies that issue the stock are unaffected and may even profit from financial slumps. Companies that offer food, fuel, utility, and healthcare stocks are considered defensive because the demand for them doesn't decrease with the economy. So when the economy goes down, people still need to eat. They still need to put gas in their car. They still need to go to the doctor and pay for their utilities. So these stocks are issued by companies that sell low-cost goods, and some of the notable big box stores like Walmart, Target are considered defensive because the demand for their products increases as the economy gets worse. And that, ladies and gentlemen, is the 7 stock classifications.